Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel L. Condon. I have Brianna Valinsky sitting in with me to interview Michael Hewson, Chief Market Analyst at CMC Markets, who always gives us a great view of things from across the pond. Michael, how you doing this morning?
Yeah, good morning, Joel. Good morning, Brianna. Good to join you this morning. I thought it was going to be a fairly quiet end to the week this week, but Mr. Draghi and the People's Bank of China had other ideas.
Yeah, so you thought you were gonna slink out of the office a little bit early and have a cup of tea, and here you are.
Yeah, absolutely.
Breaking down the markets here. So could you just did this catch you off guard, or I mean, it's kind of been in the works, hasn't it?
I think the People's Bank of China caught us off guard. The first interest rate cut in nearly 2 years. I think that tells us about the Chinese economy is they are very, very concerned about it. They've been very, very reluctant to add stimulus to the economy because of concerns about high levels of bad loans in their banking sector. But if you actually look at the economic data that we've seen over the past couple of weeks coming from China, there is evidence that the economy is slowing. And over the past 2 years, we've heard lots and lots of chatter about how the Chinese want to rebalance their economy. They want to rebalance it towards domestic consumption and away from industrialization. And that's clearly not happening. If you look at the retail sales numbers, they've been very, very disappointing. They've been declining. I mean, they've still been growing, but they've been growing at a much lower rate month on month on month. And they're currently around about 11%. Now, obviously, you know as well as I do that 11% retail sales is not too shabby. I think most of us here in the UK and in the US would love retail sales numbers along those lines. But in terms of historical precedent, that's the lowest Chinese retail sales numbers that we've seen for quite some time. And the trend is quite clear. The Chinese consumer is not spending. And I think part of the reason is that I think there is a lot of concern about the Chinese economy and the global economy.
So everyone's just like, we're ending our QE here, right, with the tapering, and it just seems like, okay, well, it worked over there. It's just like QE for the world here, and really just discounting like any inflationary pressures. Now, the gold market is telling us this morning, hey, trading up 11.7 here, 12.0260. Is it just, should we just take inflation, I guess, rampant inflation, I guess, out of the vocabulary here? Because these policies, I mean, don't they eventually just have to create just runaway inflation?
Well, you would think so, but you need wage growth, and I don't know whether it's the same in the US, but it's certainly here in the UK. We had our inflation very early on. When QE2 came out of the box out of the US, we saw massive commodity price inflation. Gold prices soared, copper prices soared. Commodity prices pretty much soared all the way across the board until around about 2011. But we didn't get the wage price inflation. So what happened was we got a wage squeeze as the cost of living went up and salaries didn't. Now what's happening is you're getting the reverse effect coming in. You're getting deflation rippling out through the world simply because I think there's a distinct lack of demand. There's still no wage price inflation. And as such, there's still a significant demand deficit. I still think people, particularly over here in the UK, are paying down debt. There's an awful lot of debt, household debt, certainly in certain parts of Europe. There's still a significant amount of household debt here in the UK, which we're still sitting on. It's around about 140% of GDP. And whereas you guys in the US, you had your housing bust. We haven't really had one here. There hasn't really been that much of a one, apart from in Spain and in Ireland here in Europe. And unfortunately, I think you guys over there dealt with the legacy of your problems a lot better than we have here in Europe. You let your smaller banks go bust. So basically the debt got written off. What's happening over here at the moment is the banking sector is still very concerned, I think, about the amount of toxic assets it has on its books at the same time as trying to boost its capital ratios.
Yeah, that's an interesting point here. So, just moving on, I mean, going back to Draghi here, I mean, there was the question of Germany, right?
Yeah, that's
Dragging
still a
their
question.
okay. I used the term yesterday, dragging their feet. Regardless,
Mm.
is this move here? Is these comments out of Draghi an indication that he is getting a little bit of a wink in the eye from from the German government that they're gonna back this?
No, I think that's incredibly unlikely. And I'm being fairly unequivocal in that. I just do not see that there's any appetite whatsoever for full-blown QE within the German government. And to be quite honest, let me throw a counterfactual at you. What if they did do it? How much lower could yields go? Where would all that extra liquidity go? You're looking at German yields at the very, very short end. The yields are negative. So really, I think it's not really a matter of the level of interest rates. It's really a matter of demand, and there's a massive imbalance within the European economy. There isn't really a European economy, but within the eurozone, there's massive imbalances in terms of unit labour costs, labour regulations between countries like France, Italy, Germany, and Spain. If you look at the GDP numbers for, say, for example, Spain and Portugal and Ireland, all three of those economies are growing. Yes, unemployment is very, very high, but those economies are growing because essentially what they've done is they have undertaken some of the labour market reforms that France and Italy are resisting. And I think there is a concern amongst German policymakers that if they take the foot off the throat of France and Italy, they will essentially just kick the can down the road the way they have done for the past 4 or 5 years. There is another obstacle as well, Joel, with
What is
respect
that?
to QE.
Okay.
There's another obstacle, and that's basically the European Court of Justice ruling on the legality of the OMT program. That ruling is still not due to be held until January next year. I think it's highly unlikely that the ECB will go into the realms of full-blown QE until they know what the ruling of that particular ruling is. So, for me, the bar still remains very, very high.
Okay, we're on the line with Michael Hewson, Chief Market Analyst at CMC Markets, here on a day where there's a lot of things going on across the pond. He's giving us his view.
So, Michael, with all of this going on in Europe right now, how does this affect the U.S. and the rest of the world?
Well, I think you're certainly seeing the effects of it in terms of valuations on stock markets. I mean, I was just looking at the year-to-date performance of all the major global equity markets year-to-date. And U.S. markets, I think there's a widespread acknowledgement that the worst is behind you guys. You're adding jobs at a fairly good lick. I think the main concern at the moment with respect to you guys is when you're going to look to raise rates, and I think that's making people a little bit cautious. I still think that is some way off. I still think there's significant headwinds from your major trading partners. I don't think the US on its own can do all the heavy lifting, but certainly in terms of boosting asset values, Mr. Draghi and the People's Bank of China have done their job. You've got the Bank of Japan doing QE, and they're looking to basically destroy the yen. Now you've had the People's Bank of China react to that. What are we going to get from, say, for example, the Reserve Bank of India? What are we going to get from the Bank of Korea? What are we going to get from the RBA? Are we in a race to the bottom here with respect to interest rates? And if so, what does that mean for asset values? I think what that means is that asset values are going to continue to rise. U.S. markets have led the rise this year. The S&P is up nearly 12.5% the year to date. But when you actually look at the DAX, it's up 1% year to date. You look at the Nikkei, it's up 7% year to date. With the amount of money the Japanese are throwing at it, the argument is it improving the Japanese economy? And I think there's going to be a healthy debate, certainly here, not only in Europe, but also around the world. Unless you do the heavy lifting of the structural reforms, are you pushing on a string? And that's really the concern that I have. Interest rates are at record lows, and yet growth appears to be being increasingly hard won. So while we may start to get continued underpinning of equity markets, what does that mean in terms of the underlying economies of, countries like Japan, China, and Europe?
That's exactly what else I've heard as far as Japan is that they have structural problems. They're fighting deflation. They're fighting the slow growth they've been having. They need to reduce their debt. We just had that announcement earlier this week from the prime minister that they're not going to increase taxes next year like they originally planned to. I mean, what does Japan need to help get itself out of its situation?
Well, you say they're fighting deflation. Core prices are trending at a 3% CPI year on year. So I think the deflation problem is overstated. Ever since they shut down their nuclear reactors, they've been a net importer of oil. So obviously that has helped. But given the fact that oil prices are now down 27% year to date, that's going to become less of an issue. Their biggest problem is their labour markets. I'll give you an example. I heard an incredible stat this week, and it's to do with the agricultural sector in Japan. They've got an aging population and they've got a shrinking tax base. Do you know the average age of Japanese farmer or the farming community is 70 years old?
You're kidding me.
That is a big problem.
Absolutely. Someone told me that they have more people buying adult diapers than baby diapers nowadays.
That's right.
Yeah.
And that is the problem. Unfortunately, their immigration policy doesn't lend itself to, encouraging immigration. So they have to reform their labour markets to allow much more immigration, if they're going to be able to service that debt. Because at some point, all these people who are retiring are going to cash in their JGBs, and at the moment, they've got a captive market. All the debt is domestically owned. Who's going to buy that debt when those people retire? If not their existing tax base.
Okay, so kind of what just putting everything that you're saying together. You're saying that okay, everyone's going with this QE, the low rate outlook or the low rate policy, and the results are not so good. I mean, so if everyone's going to keep continuing this kind of policy, we're still going to get kind of mediocre results. I mean,
they're deferring the problem, Joel. They're deferring the problem. I mean, what they're doing is they're tinkering around the edges with structural reforms, but they're not doing quickly enough. Unfortunately, I don't know what the solution is. At the moment, there's too much debt and there's not enough growth. The problem that central bankers have got is, they can only do so much. And European politicians know what they need to do. They just haven't figured out how to get re-elected if they do it.
Okay, so as long as you keep the spigot flowing, you're going to get real. And, that's another thing. If you with the short-term elections in our government, the 2 or 4 years, not so concerned about long-term policies. They're just worried about that cushy paycheck and all those perks and pushing things down the line. That's
exactly. Yeah, I think there's widespread disillusionment with politics all over the world. Politicians accuse businesses of being too short-termist in terms of their approach to R&D, and growing their businesses. But for us, we have a saying. Over here in the UK, people in glass houses shouldn't really throw stones, because I think politicians are the biggest short-termists in the world. And unfortunately, what we need is less politicians and more statesmen.
So is this all going to end badly? I mean, is this, are we just going to keep passing the buck on, or what's? I mean, are you stashing?
It's difficult to say. I mean, if you take the UK as an example, we've had a by-election today. Down in Rochester, and basically the UK Independence Party has basically taken that seat, and we have a general election in 2015. And if you look at the political landscape across Europe, protest parties are gaining increasing market share. They're getting increasing traction from voters who are incredibly disillusioned with the status quo. If you take, for example, France, Marine Le Pen, who used to be, they used to be the National Front, we were anti-immigration and anti-Euro. If there was a vote now, she would basically become president of France. If there was a vote held today. And that for me, I think the problems in Europe are more political than economic. Yeah, obviously they are economic, but what's required is a political solution. And unfortunately, there doesn't appear. The best that we can hope for is that essentially what happened in Japan with respect to Europe. In my opinion, this is a personal opinion.
Okay. All right.
Unless something radically changes politically in Europe, I think the best you can really hope for is kicking the can down the road, a little bit of deferring, but a very, very slow and a very, very painful recovery if we get one at all, because there's so many different vested interests, there's so many different vested interests that various political parties within Europe have to cater to, because then they're a single currency, but there's not a single monetary transmission mechanism.
Okay.
Like you have in the US. You have the Federal Reserve, who's the lender of last resort. There isn't really that lender of last resort in Europe. And that is really the crux of the problem that policymakers are struggling to deal with at the moment.
Okay.
And I don't know what it's going to take to generate a significant change of focus. If we get QE, okay, great. But does that solve the structural problems within Europe? No, it doesn't.
Okay, Michael Hewson, Chief Market Analyst at CMC Markets, joining us from across the pond, giving us a great look on the European, Chinese, Japanese situation. Michael joins us here about once a month, and we really enjoy it. Thanks for coming on, and we hope to speak to you again.
Thanks, Michael.
Thanks, Joel. Thanks, Brianna.